Hello and welcome to Portfolio Matters. In today's My Worst Trade, we will be discussing a trade that went desperately badly wrong this week. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, tell us about Advanced Energy.
Our last share talk was on Advanced Energy, which was drilling a well into an old oil field offshore Timor-Leste. Now, sadly, this week, the drilling news came through and it was very bad. The well failed to find the expected quantities of oil and the shares fell by 85% in a day, which is an absolutely shocking number. I have been in the stock market for 30 years and I can't remember another company whose share price has fallen by so much in a day. And I remember companies like Wirecard or Parmalat, which were outright frauds, and their share price didn't collapse in quite the same way. So I think it's important to consider what went wrong in this case and to learn the lessons. Now, briefly, the investment case for Advanced Energy, and anyone interested in the historic document that is our share talk on it should have a watch. But basically, this Advanced Energy was formed to look for neglected opportunities in old oil fields, and the Buffalo field offshore Timor-Leste was abandoned in 2004 when it was still producing about 4,000 barrels a day. Carnarvon Petroleum took over the license and they commissioned a new 3D seismic. The new 3D seismic was meant to have done a better job of mapping the field and found a neglected dome or attic with potentially a lot of oil in it. Now, the risk consultancy produced a competent person's report on the oil field, and they estimated there was a 95% chance that they would find commercial quantities of oil. And the CEO of Advanced Energy stated in interview that it was almost inconceivable they wouldn't find commercial quantities of oil. And the CEO and the chairman put in 430K in the last round. So they had skin in the game. Now, there has been commentary about, should we have known, etc. It was known that the 3D seismic was difficult because of the geology of this field. Now, frankly, I don't think as private investors you can second guess consultancies who have vastly more information than you. Private investors are always at the end of the information chain. We have to take the word of professionals. And so I think we were correct to evaluate the field on the basis of the information supplied. And frankly, when I look back at doing this trade, I don't think that I did much wrong in terms of the size of the position or in buying Advanced Energy on the basis of the information supplied. This is not going to be a knee-jerk reaction, but I think there are very important takeaways. So, in summary, the lessons from this My Worst Trade are going to be: number one, do not put in limit orders close to a news event. Now, various members of our Discord channel had limit orders to buy shares in Advanced Energy slightly below the current share price, aiming to buy it on dip. Now, when the share price collapsed by 85%, they got filled and essentially bought into this enormous share price collapse at a high level, guaranteeing them huge losses on their whatever they'd put in. Number two, and we have covered this before in various my worst trades, but whenever there is a news event, you need to watch the share price, because insiders in the company will know what the news is before the actual news is announced via an RNS, and their trading will reveal that knowledge. And so you will see on the chart coming up that the day before the RNS announcement, the share price of Advanced Energy strangely drifted off. Going back to the limit orders point, the idea of buying limit orders, putting in limit orders, is that is mean reversion. You're expecting that if the shares dip, that they will bounce back up. And that is precisely the wrong strategy when there's a news event coming up, because insider buying or selling will tend to create momentum. So it is best to buy shares that are going up in advance of a news event, and not buy shares that are dipping in advance of a news event. But finally, and the most important point, is that I have reflected on all my trades over the years, and we will go through these in Wildcat Drillers. And this is actually the latest in a long line of disasters for me. And I can't think of a single Wildcat driller where I have made a lot of money. And so I will now, from now on, stop investing in Wildcat drillers. And although I do have some in my portfolio, I will sell those in advance of any news event, because I think what this experience has crystallized is the fact, prior to the drill result, there is already a lot of optimism in the price. And so when you look at the share performance of these Wildcat drillers, there tends to be a spike when good news comes through, but that tends to retrace itself afterwards, and you can buy in later at a good price without taking the exploration risk. So bottom line, from now on, Portfolio Matters is not going to cover any Wildcat drillers. Instead, we'll only look at companies with proven assets or development assets, and if they have Wildcat drill prospects, we will only cover them if those are incidental to the investment case. Okay, now on the first point, limit orders being filled. Now this is the minute by minute share price performance of Advanced Energy on the 19th when the news came out. And you will see the share price didn't go from the best part of 5p straight down to 0.7p. There are these little ticks down on the way, and those sadly were limit orders being filled. And I know from our Discord that various people had left limit orders in. Be very careful. Don't leave limit orders in around news events, because if the news goes badly, you will be systematically bailed into a losing position. And on the point about insider trading, you will see that in the days prior to the drill hitting the reservoir, the share price was drifting up on optimism. And then the day before the RNS announcement, it drifted off. Interpreting the fall in the share price the day before, which I was aware of, was complicated by the fact Advanced Energy announced their interim results that day. And if you were following the company closely, it might have been wise to trim positions at least in response to that news. So if we go through some of the wildcat drillers I have previously invested in. The share price of wildcat drillers does not reach a peak on drilling success. It reaches on speculation. Actually, drilling success tends to be followed by a period in which the share price falls and it's possible to buy into the resource cheaper. So risk adjusted, wait until after successful drill and then buy in. Now, if we look at Petrometad, now Petrometad, you'll be aware that I've done for Share Talk and I have a good sized position in now, which I bought last year. But I also held it historically. So we go back to 2015 when it had Shell and British Gas then farmed in to fund their exploration campaign in Mongolia. Well, the peak of the share price was on speculation when they announced the drilling campaign and the share price shot up to 30p. We now move forward through time. Of course, they had to raise money, which always depresses the share price. And then there were a whole series of dry holes. Snow leopard, dry, share price fell. Wild Horse was one of the biggest wildcat drills in the world in 2018. Dry, big fall in the share price. Red Deer, 2019 was dry. Now, the Heron, which is their one successful oil field, which they are developing now and is the basis for my investment, that is that tiny little peak there, 9th of September, 2019. And if we look at Gazelle 1, which was a partial success, I think this is very indicative of the sort of share price performance you'll see from a successful drill. You see the share price shoots up on the day and then drifts off. And then we know that in order to bring Heron 1 on stream, you're going to require more money and time. And during that period, that orphan period, when the company is essentially attempting to raise money and get the well into production, there's very little news and the share price tends to drift off. That is the time to buy, not in advance of the drilling news. Okay, moving on to Chariot, which had a big explorations in Namibia and offshore Morocco back in the day. And you'll see the share price reached its peak on speculation before the drilling campaign even started. And we had results from Rubat 1 in 30th of April 2018. It was dry, share price collapsed. But you'll see that the share price rose in advance of the drilling campaign and before the share placing. So the company's responded to the very high share price by doing a share placing, which partly collapsed the share price. And then the Prospect XS exploration well in Namibia also failed. Share price collapsed. And then in 2019, they farmed into further offshore licenses in Morocco and commissioned a new 3D seismic. And recently, their new well on the Anchois field, which they knew contained oil and gas, was a success and the share price has shot up, but now it's drifting off again. And I would advise buying into that development after the share price has drifted off a bit more, but knowing that they now have commercial quantities of oil and gas. And the biggest lesson, I think, is in Rockhopper. Now, Rockhopper, back in spring 2010, discovered oil, big quantities of oil, offshore the Falklands Islands. And you'll see how that discovery, that wildcat discovery, that was the first wells ever offshore the Falkland Islands, led to a huge spike in the share price. Great news. But then the share price came right back down. So actually, over the months before and after that success, the share price had not moved. And so big drilling success offshore Falklands did not result in sustained rise in the share price. You could buy into Rockhopper after success at the same price as before success. Now, if we go forward through time, 2011, Rockhopper did 8 more wells and found six of those were successful. The share price went back up, and they then farmed out to Premier Oil for $1 billion. 10 years later, naught has happened. So last year, Harbour Energy, which are the successor of Premier Oil, due to a merger, they relinquished their shares in the Sea Lion project, and Navitas have now farmed in, but the Sea Lion is not developed yet. So the bottom line is, even after a successful drill campaign, you have years to bring these wells into production. And during that time, the price tends to sell off. And if we go to the life cycle chart of a mineral discovery, so previously we've used this chart for mining, but actually it applies equally well for oil. Investing in wildcats, we're investing here, expecting a spike in the share price when the drill comes through successfully, but then the share price tends to drift off in the years between the discovery and bringing it online. And the risk reward profile of the investment is much better if you wait till after they've found something and invest when they start to bring it online. And that is what I will be doing going forward. So in summary, I'm going to learn the lessons from this. I've known this before, but I've actually not done anything about it, but it's crystallized my thinking. And from now on, no more wildcats. I'll only invest in companies with a known resource. So I will invest in companies where they're doing an appraisal well on a known resource, but generally be sticking to companies with production or production that's just going to come online. Richard, your thoughts?
Yeah, thanks, Keith. Interesting. I mean, I feel it's salutary, isn't it, to see a company where basically all of its future is predicated upon one success, and that success doesn't occur; it fails instead. So we all learn about investing all the time. You know, there are always lessons to learn, always things to think about, and I think the lesson here. I mean, you put they could talk together, but one of the lessons here is your risk-reward ratio, isn't it? And if you're invested, you know, in 10 of these small speculative companies, and 8 of them don't succeed and 2 of them succeed, then in order to break even, the 2 that succeed have to go up 5-fold, and you have to get out at that point. That's a break even. So they are very difficult.
I think your point about the risk-reward profile is absolutely the thing to take away, because actually, you think about Advanced Energy, if they'd hit oil, what was the upside? Well, actually, the share price would have spiked, and you might have made 50, 100% return, but it's likely the shares would have drifted back down. And when you think about losing 80% or when it failed, I mean, the risk reward profile is just, I mean, that's 50-50 just about, so it's not good enough.
It's not, is it? And I think we all have carrying this in our head. So I certainly in my head, this image of you get the right one, it's going to go up 15 times. And well, and there are examples of that, but of course, there's an ascertainment bias in it as well, isn't it? We are aware of the ones that we can't read about in the newspaper or whatever, the ones that go up 15 times, and we don't read about all of the hundreds probably that fail.
Well,
So
actually, on that point, Richard, the ones that go up 5 to 15 times, they're the ones that start production. The market sees that the production is good and is growing, and then you get a steady rise in the share price over a long period of time, or over a year or 2 years. You don't get, bang, 0 to 500.
Yeah. And then the other thing I think is we also used the value valley graph, which I think is really great for minerals, but we haven't actually related it to oil. But of course, it is equally applicable to oil, and I think that's a big lesson as well to remember that is the hope. There's a lot of hope in the price. The hope is fulfilled by a discovery, and then everyone gets bored because they think the price is going to go up and it doesn't, so they all leave. And there's dilution taking place. So in that context, I'm going to change the subject very slightly and go back to what you refer to as our problem child, aka Rambler. So in this scenario, Rambler has a resource. We know it's there. We know how big it is. Where do you put that in the context of this type of investing?
Okay, so it's not a discovery. So I don't think this discussion about Advance is actually relevant. I mean, the thing about Rambler is the question is, not whether they've got resource. Resource is big, great, high grade. It's a question of whether they can actually develop it profitably and, frankly, change the news cycle. The news cycle has been unrelentingly negative.
So in some senses, it is relevant to this because what we're saying here is actually steer clear of the speculations. Wait till the resource is confirmed, and then consider your investment. So Rambler is sort of one where the resource is confirmed, and then you may or may not invest, but you are then looking at a long holding period for the value to be realized. A little bit like Rockhopper.
Yeah. Yes, that's right. Essentially, if anyone had bought in advance of the Rockhopper exploration, well, they then found, enormous resources. Everyone's super excited. A decade later, they'd have a tiny fraction of their investment left. So bottom line is, there's huge amount of optimism already baked into the price, even before the drill, because lots of small investors in particular, like the excitement of these wildcat drills. And I think I've finally learnt my lesson with Advanced Energy, and I'm going to be avoiding them in future. Now, I do have a couple in the portfolio, and I will be selling those when the drill bit first hits. So in advance of results, on the speculation that of success.
Well, good. We'll see how you get on. You'll have to tell us. We'll have to do a retrospective on them, Keith.
Yes, well, if and when they actually do some drilling, I will be selling out, and I will inform viewers in the weekly. But anyway, thank you all for watching. I know that a lot of our Discord members lost money on Advance, so hopefully we've all learnt some lessons from it. But thank you all for watching. Please, can you press like and subscribe to the channel? And in the meantime, it's goodbye from Richard Wheater.
And goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.